my name is Sylvie. I am the main field agent for Land for Good, and Mike is here who'll be giving our presentation on financial considerations. And we also have a guest speaker named Nick, who Mike will introduce. A little bit of housekeeping first. Please keep your mic muted unless you're speaking. While the presentation's going, please put any questions you have in the chat and I'll be collecting those. And Mike will also stop and pause for people to be able to ask questions throughout the presentation. We want to thank our sponsors, which include the Vermont Housing and Conservation Board's Farm and Forest Viability Program and our Northeast SARE grant.
I'm going to spend about half an hour, 40 minutes talking about retirement specifically, and then the remaining hour and a quarter or so is going to be Nick on tax issues. I'm going to talk a little bit about long-term health care along the way, and we're going to also pick back up on that with the attorney next week. Okay, so retirement plan and retirement. I really encourage farms to think about this not just as a part of the transfer plan. I've been working on transfer plans for close to 20 years now, and the one thing that I've definitely seen is I'm sitting down with farmers trying to help them assess what their financial position is for retirement, and at that point, it's a lot of things have already transpired that we can't go back and change. You can't add more to what you're paying into Social Security over the years. You can't save money for 30 or 40 years and or even 20 or a decade and take advantage of compounding. And so we really need to get the younger generation farmers thinking about this. And I have definitely worked with younger generation farmers who are thinking about this. So that's as well as older generation farmers who have who did do things to provide for their retirement throughout their life, and so they are in a different position. So I really encourage people to be thinking about this younger and trying to think about how do we get more young farmers to be thinking about retirement. Um, so what happens when there is no plan and there is no savings? So a lot of farmers I work with don't believe they're ever going to retire. They're going to die on the tractor. And but then they find out later in life either that they want to retire or they need to for some sort of, health reason that's preventing them from being involved in the farm anymore, or greatly limiting their ability to be in the farm, or there's an economic reason why the farm needs them to step aside because the farm's not doesn't have the capacity to continue with them farming unless the business was to change and bring in a dramatic increase in income. And so they find themselves unprepared for that to happen. For many people, because they haven't been paying into Social Security because they've been working too hard to not show any income on their Schedule F. Bob Parsons, who some of you may have known, who was a dairy economist at UVM, who did these programs through UVM Extension before he died well too young from colon cancer. So get your colonoscopies. And then I started taking these over. He used to say, the 11th commandment is thou shalt not show a profit on the Schedule F. And so as a result, many farmers are not paying self-employment tax sufficient to really get as to maximize their Social Security. And with little or no outside savings, the sale of the farm assets become essential for retirement, and that becomes a challenge for making things affordable for that next generation in retirement. If that older generation needs that to maximize the returns on their farm assets. But then a compounding factor is if the debt is too high when they enter retirement, there may not actually be much left over after they sell those assets to fund a robust retirement. And one thing that Nick is going to cover that people are not often considering is the fact that they're going to sell those assets that they probably fully depreciate, and they're going to have to pay capital gains tax. So there's ends up being much less available than when people think there might be, considering the assets that they have. But on the other hand, we want to make this positive, is when I've worked with farms that have, an adequate amount of money coming in, there is or alternative funds to the sale of farm assets. There ends up being a greater flexibility in when and how they can retire. One farm that I been working with over the last few years, sat down and looked at their situation, and I pointed out to them, between the savings that his wife and he had done, the Social Security they were eligible for, the fact that they had didn't have any substantial farm debt that they couldn't pay off, and in the end, that he didn't have to sell a single piece of equipment in order to retire, and that allowed him a great deal of flexibility in terms of the transfer to one of his employees, who is now just completed his second growing season on this vegetable farm, is renting the farm while he's building up equity in buying the farm, the operational assets, the intermediate assets. And it's working out financially for both of them as a result. Higher Social Security, Social Security is still only pays a portion of people's retirement, but having a higher Social Security means less reliance on other sources. And then if you do have the retirement savings, it just reduces that need to maximize on those farm assets. And there's just different structures and different approaches people can take. If people have to retire and they have to sell those assets and they have to get out from under the debt, then often it's like everything has to happen at once, and we don't have the ability to provide some flexibility to make things more affordable for that next generation. Getting away from the financial part of it for a moment, the first question that I usually ask people, when I'm sitting down and having a conversation is, do you plan to retire? And as I've already said a number of times, many people say they don't. But I definitely work with farmers who do plan to retire. And I do work with farmers who sometimes have a very definitive time frame. Other times it's a little bit more vague. And so I ask them, what do they mean? What do they mean by retirement? What does that mean to you? So more than once, I've had dairy farmers. It's almost like I don't know that they've ever shared this with other farmers, but I've heard this phrasing more than once. It says, well, when I get to be 65 or 67, I don't want to stop farming, but I just don't want to be in charge of a herd of cows anymore. That it's a bit impressed me that phrasing has kind of been passed around somehow. By that they mean they want to keep being involved with the farm, but they want somebody else to have those responsibilities and headaches of figuring out how to make the money work. Maybe there's certain tasks they don't want to milk anymore. They want to they like working with crops, or they like working with the calves or whatever it is, and they just don't want that level of responsibility anymore. And I've talked with vegetable farmers and orchardists, and there's similar phrasing, similar things. There's things they want to do the more fun parts of the farm, and they want to keep working, they want to keep active, they want to keep involved, but there's just a lot of things that they want to unburden themselves with. So another key question I ask is, when does this start? Because it does help kind of line up the time frame, both for how do we start getting the successors ready to take over? What's that time frame? Are we trying to identify new successors because there isn't anybody on the farm, whether it's family or employee, that might take over? How quickly do we need to be looking for these successors? And as I was saying last week, this time process can take a lot longer than people think. And so, if people are looking at saying five, or looking, say, I want to be retired by a certain age, and we're looking, that's 5 or 10 years out, then we've got a good frame to work with. If it's going to be in a year or two, that gives us a lot less flexibility in terms of how we go about things, and to line everything up and how quickly we have to work. As I mentioned last week, 5 to 10 years is a good time frame for people to work through all of these, especially if you don't have an identified successor. And I mentioned this at the Vermont Vegetable and Berry Growers meeting, several years ago, and a farmer came up to me, Tim Taylor from Crossroad Farm in Thetford, and he said, 10 years is when my wife and I want to retire, and they didn't have an identified successor at that point. And as we worked through this over the next, ended up, I think, being a total of 14 years. His wife, Janet, who had the similar thought of 10 years, she did retire at 10 years. That was her definitive thing. So she stepped out of the partnership that we created with their employee sooner than Tim did, because Tim was enjoying actually working with a partner to share all that responsibility with. But having that window did allow us all that plan, including figuring out if Phil wanted to become a partner, and then working him into the partnership. And then, how do you see yourself transition in age? Is it going to be something where you're going to step right out, or you're going to see phase? I want to be at this stage. I want to be only doing these things. At this stage, I want to be doing these things. And at this stage, I think I want to be out. And I think it's not just about the financial part. It's thinking about what is going to be important to you and what you're going to be physically capable of. How important is it for you to retire? How important is it for you to stay working in the farm? That the emotional part of this is actually sometimes the trickiest part for people to think about in the retirement. And it does sometimes mean that people also do change their perspective as they get older in both directions, sometimes not wanting to leave as quickly from the farm, and sometimes wanting to accelerate it more, that they're more burnout, or just realize that there are other things that they want to do, especially if they have a health issue come up, and say, you know what, there's some things I really want to do that are not farming for a while, and I want to have that chance to do that before these health issues become worse. So then when we get back to the money part of it, I try to figure out sources and uses. So what are you going to need to use the money for? What is your annual cost of living? And I work with some farmers that have very, very good farm financial records and lousy personal finance records. And they really have no idea how much they need to live on. And it's really common, and it's not just farmers. We hear this all the time. A lot of Americans just don't know what their cost of living is. So I work with people to try to figure that out. And I ask them to figure out how much does the farm cover now, because it's very common that, say, all the firewood for the house comes out of the farm. Maybe there's one propane bill for all the greenhouses, and it's also the propane for the house. There's the food that you get from the farm. There's maybe one electric meter, and you kind of have an allocation in place for tax purposes, but you don't really know what it's costing you. And I said, look, I don't really care what you're doing on your tax forms. I want to know what your actual cost of living is now. So we'll spend some time on that. And we do, in our workbook, we have that I was mentioning last week, we do have a retirement worksheet for family living. And going forward, depending how your transition is going to go, is going to dictate, it may dictate how much the farm may still cover in the future. It may still continue to cover all of those family living expenses that are being covered by the farm now, or maybe some of them will go away because they're just strictly farm expenses, or just that the farm is just going to strictly cover them, and the next generation doesn't want to pay your electric bill or your propane bill or something like that. And particularly if you're going to maybe sell the farm, of course, that is all going to change, and that becomes a little bit of a challenge. And so one of the big questions that comes up is, where are people going to live? And one of the questions, if you're going to stay in your house, is, can you age in place? And I look around with people, like, how many steps does it take you to get in the house? Do you have to go to the basement to fill a wood furnace? If you had to be on the first floor for some health reason, like a knee replacement, really common thing, knee and hip replacements with older farmers, can you be there if you can't do stairs? How easy is it for you to manage that house as you get older? But if you're going to have another generation come into the farm, are you going to be able to stay there? Is there enough room for everybody in that one house? Is there another farm labor house already on there that they can be in? Or would you move into that other house? Um, and they move into the main farmhouse. When I got out of college, I worked at the Rodale Institute in Pennsylvania. A lot of Amish farmers around there, and they all had what they called grandpa houses, where the grandparents would move in when the next generation took over the main farmhouse, and that's not unheard of here in New England. Otherwise, besides the Amish community, but it's not the case for every farm. And so sometimes it gets to be really tricky if we're trying to figure out housing for two generations, particularly with what construction costs are now, or if there's a conservation easement where nobody was really thinking ahead about multiple generations staying in being on the farm, right? And then there's just simply the expense if you were going to buy adjacent housing nearby becomes an issue. And so a lot of times we spend a lot of time just trying to figure that out, trying to figure out is what makes financial sense, what's practical. Do we make the house a duplex? Do we share the house? Do we build another house? Do we sell the farm and take the proceeds and try to find another home in the community, in the community or somewhere else? One of the biggest challenges besides the housing for figuring out whether or not or figuring out what the budget is for a person in retirement is long-term healthcare needs or even short-term healthcare needs. And we'll talk a little bit about those today. But it's I don't think there's a lot of great answers out there here in the US. Unfortunately, we have a dysfunctional healthcare system, and it doesn't get much easier, but we do our best to be as realistic as possible about what those costs might be. And I encourage people to be realistic in general about what those family living costs are if they haven't been tracking them. I do try to get people to track them if they haven't been, but when we're training a budget, I want people to make sure they're using real numbers and not fantasy numbers about what their cost of living is. There's what is called the retirement smile. Don't pay much attention to the ages because that can really shift depending on people's needs. But when it comes to how much money you're going to need in retirement, there used to be that they would say that you need about 80% of your pre-retirement income in retirement. Well, a lot of people say that's not true at all. You need at least the same amount. And for, some farmers that I work with, they actually need a little bit more because they promised their spouse that when they retired, they would actually travel because they never could travel with the farm. And so they've got, at least in those first few years, they're doing some more traveling. And they said, when we retire, you're going to renovate the kitchen. I've seen that multiple times. And so you start putting some money back in the house that you didn't do. So it may actually be the same or higher as what you're doing while you're farming. And then usually people slow down, they travel less, they don't buy they don't buy another car. They make the one last, what farmers do anyway. But they just think about they're just spending less, and so it may drop in there. And then the real challenging part of this smile is the part on the other end where healthcare needs may go up later in life. So you have to factor in inflation. I've had this slide up long before the inflation era that we just went through 22, 23, 24. And it really didn't mean so much to people when I was using this slide and inflation was down, sometimes it was near 1% or less, and definitely less than 2%. But the average inflation for, I don't know, probably the last century or so has been about 3%. I just heard the latest number was 2.7%. And the Fed wants to get us below 2%. We'll see if they get there. But of course, a few years ago, we were 9%, 10%, something like that. And so the average is probably still around 3%. So if you need about $40,000 in family living income now for retirement, in 10 years with 3% inflation, you're going to need 51,000 in 10 years. And in 20 years, it's going to be 68,000. So you need to be thinking about that when you think about how much money do I have for inflation. So what are the options that farmers have for covering their cost of inflation? Um, the these are the main areas that farmers will get for income for income for retirement, excuse me. And usually I see that most of these are involved, and that it's a combination. It's not any one thing. So Social Security, investments, if people have the IRAs, or if somebody worked off farm, had 401ks, or other kind of retirement savings. A lot of spouses work off farms, so they may have some retirement income, including, I work with people who had worked for the state or teachers and they have a pension plan. Some people will keep working, of course, maybe part-time, maybe less. And sometimes they'll work on the farm and sometimes they'll work off. Sometimes they'll go work for other farmers. I know a number of farmers have been really kind of excited. This retired farmer down the road, he comes and does a bunch of tractor work for me. And I know I can count on him because he's been, he did it for his own farm for years, and I got him in the spring when I need him. Um, Passive income, people have residential rentals, they'll have timber sales, cell tower and energy leases. And then, of course, we get to the sale of the farm assets, equipment, livestock, equity if you're in a dairy cooperative or another type of cooperative. Renting the farm, sometimes that's a break even, but sometimes it's structured at market rent. It brings in some income. And then the sale of a conservation easement if it's not already been sold. Once you sell those in New England, all the New England states, it's for perpetuity. So you only play that card once. With Social Security, this is one of those areas I've already mentioned. I warn farmers to pay attention to because it's based on your top 35 years of earnings. And many farmers hurt themselves, as I mentioned earlier, by having tax avoidance strategies where they're not showing their income on their Schedule F, and therefore they're not paying the SE tax, which is the self-employment tax that goes for Social Security and Medicare. And a lot of times they're only reporting Social Security for one spouse and not the other. So that should be taken into consideration. The positive thing on Social Security is that Social Security is adjusted for inflation, unlike many other retirement sources, most other retirement sources. So they have what's called the COLA, or cost of living adjustment, that during those periods of high inflation in the last few years, we had the biggest COLA adjustments that had happened since the 1980s. Um, you can start to withdraw at 62. And then we always look at what you can get at 62, what you can get at whatever your full retirement age is, which shifts some, and then everybody needs to claim by age 70. From your full retirement age to 70, your benefits will increase by about 8% a year. And one thing to consider, though, is that Social Security uh, takes into account that people are going to draw at different ages. And so when you get the lower amount at 62, they figure that they're probably going to pay you the same amount of money over time, up to the point of your death, as if you were to take it at age 70, because you're going to have those 8 years you didn't take it, but you're going to get that higher amount at 70s. And so the break-even point for most people would be around 79 or 80. If you live past 79 or 80, you're going to be better off after that if you took it at age 70. If you died before 79 or 80, you might as well have taken it at 62. There's a whole lot of other factors to consider, so I'm not telling people what age to take it at, but I think it's not as straightforward as people think when they say, I'm going to wait until 70. So I think if you talk to the Social Security Administration and your financial advisors, they can help you figure out when to take Social Security. I point out to people that, if you're concerned about not paying taxes so much when you show a profit on the farm, that, you can show the profit, pay your self-employment tax, and then use other deductions in IRAs to reduce your income tax liability. So you're still paying the Social Security and you're saving. You're saving on top of that and taking advantage of the fact that traditional, as opposed to a Roth where you get the tax benefits on the growth, the traditional, as an example, or when you would get that tax deduction at that in that year that you're filing those taxes. And so think about that, and not always just about figuring out how to reduce your income so you don't pay taxes. Think about using the tax code's benefits on retirement as well as doing things like Nick could talk to you about, or Nick would work with you on as far as prepaying expenses, buying equipment, that sort of thing. If you're doing all that sort of stuff to make all the taxes go away and you're not paying enough into Social Security and you're not taking advantage of the tax code to save for retirement, you could be cutting yourself off later. If you do have a need to make those kind of investments, I would say go ahead and do those. But if it's just for tax reasons and you're not considering the retirement issues, then you're potentially, cutting yourself off from, the future benefits. Um, Retirement savings. This is, of course, a challenge for many farmers. Um, to think about. But as I said, this is something that I have seen both current young generation farmers and farmers that are already retired who have managed to make savings work. Of course, it's hard with any farm, particularly in difficult years, to think about that sort of thing. But there are farmers that have made it work. They don't usually talk about it publicly, so people don't know that. Um, but the general rules of thumb is to start as early as possible. And if people get in their 40s and 50s, and that's when they finally can do it, I say, still start then. Contribute as much as you can, even if it's a small amount. Don't worry about the kind of recommendations of this percent of your income. Do whatever that you can. Wherever you put your retirement savings, watch out for fees, because the fees will, potentially eat into your retirement benefits. If you want to work with a financial advisor, make sure that they are what's called a fiduciary. Fiduciary, their responsibility is to work for your interests and not just their commissions on selling you on investments. For some people, putting money in investments, they don't like the idea of where the money is potentially going. So there are socially responsible investment funds that people can think about that are tied to IRAs. And then one key thing I really encourage people to think about that I see farmers kind of miss a lot, and probably the general public in general, is that as you get older, you want to look at your asset allocation and you want to be moving things from a portion from stocks to less risky investments such as bonds or money markets as you're getting closer to retirement, so that if there is a stock market crash, your retirement funds uh, are less vulnerable. Um, what I do with people then is I ask people, get your Social Security reports. If you're not already on Social Security, get all of your investments together, and we start to look at what are the sources that we have before we get into the farm asset sale. And we'll do a crude budget using the 4% rule. So the 4% rule is based on the idea that you would have a 50-50 stock bond portfolio that's yielding at least 6%. That inflation is at 3%. And so basically, if you had $100,000, you could in your investments, you could take 4% out, which would be $4,000 in that first year, and that would be a safe withdrawal rate. All right. Now, some people argue that it needs to be more or less. It's actually, if you have that kind of portfolio, you could probably some people say you can do 5%. If you don't, if you don't have it in anything that's yielding 6%, well, then there's definitely an argument to say, well, maybe you could only withdraw 3%. But usually we're taking, like, this is a crude number to start with. Again, if you want to work with a financial advisor on this, make sure they're a fiduciary. Um, and this is again withdrawal rate is based on there being growth. And so when you're looking at just the total savings and when there's no investment or no interest, it will be gone. If you took 4% a year out, it's going to be gone in 25 years. So if you have 100% or $100,000 and you start taking it out, you took out $4,000 a year at age 65, it's going to be gone by 90. So if you live past 90, you're not going to have the money anymore because it wasn't growing. Also, that $4,000 isn't going to buy you in 25 years what it's going to buy you now because of inflation. So that's just something to really think about, because 4% often seems like it's a really small amount to people. But that's the reason why you're thinking about generally a long horizon, and you're also thinking about inflation. All right, so now we get to the asset sales. So Nick is going to get us into the tax implications shortly. And I think it's important for people to think about the tax implications as well if you're thinking about a conservation easement sale, or if you did a conservation easement sale in the past, because what I've observed is that many times people did not pay taxes on their conservation easement sale because they had enough tax basis, which if you don't know what that means, Nick's going to go over that. They had enough tax basis that what their accountant did at the time was just reduce the tax basis by the amount of the conservation easement sale. And so they paid no taxes at that time. And they don't realize when they're going to sell the farm real estate now that they have this much lower basis and they're going to potentially be more subject to capital gains tax in the farm sale. Um, as I've mentioned a couple times, the debts need to be figured into this when you sell these assets. You know, first people you're going to have to pay is your lender. The next people you're going to have to pay is the tax account. How much is that going to, or not tax account, but for the tax collector. So, how much is that actually going to leave you afterwards? Sometimes installment sales can be beneficial to both generations. And Nick can talk a little bit about the tax implications. But of course, there are risks for both parties, and you need to make sure that if you're going to sell to that next generation and you're going to be the lender, that the borrower on the other side has the capacity to actually make those loan payments. And just to reemphasize that, easement sales here are for perpetuity and they can only fund one generation's retirement. So we have a number of farms out there that the sold the easement 30 years ago. And now they're getting, the easement was sold by their parents so that they could they could have something to retire on and they could sell the farm to that next generation at a lower cost. Well, now this generation is getting ready to retire and they can't do that again. Now sometimes in Vermont, you could add the option of purchase at ag value, which will bring in some extra money. But the point is that we've used this tool a lot for dealing with the fact that there wasn't other retirement savings, but once it's sold, it's not going to be available to the next generation to do that. All right. So do we have any questions in the chat?
We do not.
Okay. All right. I'm going to quickly just go through these healthcare slides because I want to get Nick on, and because we're also going to talk about healthcare next week with the attorney in more detail. One thing that I put up there, I'll try to get the link in the chat. There was a really good Medicare explainer in Vermont edition of Vermont Public Radio back in 22 that kind of explained some of the parts of Medicare. But even better than that, if you go to your local council on aging, you will often be able to get direct support. I know here in Vermont that the Council on Aging provide direct one-on-one support for people to figure out the different parts of Medicare. You want to make sure you sign up at 65. I've seen farmers make this mistake a number of times where, so I'm not going to I'm not going to retire at 65. I'm not going to draw Social Security at 65. And even though the letters told them they still need to sign up at 65 or get a penalty that's, I believe, permanent on their Medicare, they didn't sign up at 65. So you need to make sure to do that, or that your family members are doing that. There is going to be some out of pocket for many people. So you can't just say that, and it also, the premiums will come out of your Social Security. So you need to not just think it's all going to be there for free, except for some people who do qualify for Medicaid. One critical question, and we'll be definitely talking more about this next week, is that Medicare is for acute short-term care and not long-term nursing home care. They can go into a nursing home for a short period of time as a rehab that Medicare will cover, but then after that, you can apply, but you'll generally get turned down, as happened with my father-in-law, for continuing to have Medicare cover nursing home care later on. And so it's confusing to people, but it's Medicaid that we're talking about for long-term care, not Medicare. And so the real wild card in terms of budgeting for all this is what is, what is your healthcare needs and what will they be? Now, some farmers I work with, they know they already have Parkinson's, they already have dementia, right? So we're having a much more specific conversation about healthcare costs than vaguely when, I'm healthy as a horse right now. And that's what makes it so tricky to budget for this.
Mike, could we have you go back 2 slides to the easement one? We have a request in the chat. This one right here.
Yeah.
Thanks.
What is the question?
Anita just wanted to see the last, I believe the easement sales were only found
Okay.
that only fund one generation.
Long-term healthcare costs are very high, about $14,000 to $15,000 a month. Losing the farm to healthcare, or I mean to the nursing home, is often a concern that drives people to us. But they don't want your farm. They just want to get paid. And so this is the tricky part about trying to figure out how to address this. And so most people are trying to make themselves Medicaid eligible. We're going to get into more details about that next week. I'm going to say this now, though, and we'll reemphasize this next week. If you're going to gift away any assets because you're concerned about not wanting to have them in your name before you go to a nursing home, there's a 5-year look back period. And so that transfer needs to happen at least 5 years before you need long-term care. There are elder care attorneys that you can help you with asset protection. We'll have one talking next week. I also encourage people to think about, well, what other things besides going into a nursing home, because most people don't want to go to a nursing home, that you can do to be able to try to address long-term health care needs. And so many farm families I've worked with have figured out how to provide care, especially if they're all living and working near each other, to someone, and so that they can stay in their home. It's not always practical, but it is something that can be considered, it can be discussed, and sometimes does work out for people. Long-term health care insurance is expensive. Uh, we're going to talk more about that next week, but it's not a great tool out there, unfortunately. Some insurance does have a death benefit. We'll talk more about that next week. There is some good information on longtermcare.gov. And then you can also talk to your insurance agent about long-term health care if you think it's something you might want to consider. And with that, if we'll see if there's any questions, and then otherwise we'll turn it over to Nick.
I will direct you to the chat, Mike, because there is a little bit of conversation about trusts and easements. So if you could just read through and if there's any clarity that you'd like to provide, or if that sounds about right to you.
Well, is there a specific question here that maybe I'll look through them and address those later so we don't hold up Nick, okay?
Perfect.
Hello, everybody. Thank you for having me. My name is Nick Bullock. I'm with Farm Credit East. I've been doing taxes for about 25 years now. Let me get my... All right. Hopefully you can see my tax opportunities for farm transfer planning. People sometimes associate tax with the only bad things that happen, but there's some opportunities to have when you're selling the farm and when you're moving on, and with transferring these farms from one generation to the next. Lots of ground we are going to cover today. I'm going to kind of stick to about 30,000 feet of getting into the tax stuff, but we can answer questions along the way. I know the easement sale, we can talk about that. We'll cover some of the technical terms that got mentioned earlier. The first one is the basis, a quick description of what basis is. It's what you pay for something. But we've had different basis definitions that we were going to cover. But that's when somebody's talking about their tax basis, it's typically going to be what you paid for something less maybe the depreciation that you took. All right. So, there's a bunch of things that we kind of do in a farm transfer. There's gift estate tax, there's income tax. We got to look at, is there cash flow to make this thing happen? Mike mentioned long-term care. You guys are going to talk about that next week. That's a really important part of this whole thing. One last thing, I do talk a lot with my farm transfer people and families. I deal with a lot of families when I'm doing this, partnerships, corporations. But typically there's one or two children on the farm, but maybe that's not all the children. And the difference between, is it equal versus equitable? Something doesn't always need to be equal to be equitable for the whole family. And there's a lot of different things like retirement. Say somebody was very forethinking and funded their retirement, and it's not, they were able to accumulate a sizable pot of money that's outside the farm that funds their retirement, but there's also more that can kind of get that equal, equitable thing. So the retirement funds can go to one child while the farm kind of can go to another. So there's a lot of different things that we talk about with farm transfer planning. I'm going to start with gift and estate tax. There's been some big changes. I've had the same slides for many years when I'm doing this. And we haven't had a lot of change, but with the recent legislation, there's been some big movement on estate tax, which is kind of nice. Some long-term kind of hopeful solutions, because it was quite shifty ground. Every time I have to talk about the lifetime exclusions and all that, I'd say, okay, well, we know what we're doing until 2025, 26, and then so thankfully they came up with some new guidance. Basically, the estate and gift is, the generation, they give their assets away, and if it's over a certain amount, well, they have to write a check to the IRS. You're able to give, this year it's $19,000. You can give $19,000 to anybody you want. Family, non-family, anybody, without having to report anything to the IRS. Over $19,000, and you can do combined gifts of $19,000 per husband, wife. So it can equal up to $38,000 that you can give away in each year to a certain person by utilizing this gifting rules. Now, when I say the gifting is after $19,000, you just have to file a gift tax return saying, I'm using up my lifetime exclusion over this amount. And that's done on a gift tax return. So if you give somebody $20,000, you're supposed to fill out a gift tax return saying, hey, I gave $20,000 to my son. It was over that $19,000 limit. I'm using up some of my lifetime exclusion. Now that lifetime exclusion has kind of changed over the years. Thankfully, they like I said, the legislature gave us some guidance. It's now $30 million in the federal exclusion amount, and it's been indexed for inflation after 2030. So kind of exciting about this. I actually got to change my slide, which is nice. So that's that lifetime exclusion that we're talking about. So you can give somebody $19,000 this year, and if you give them, say, $50,000, you just have to fill out that gift tax form to report that you're using up some of this $30 million. They do keep track of it. I'm pretty sure there's a large warehouse somewhere in the IRS archives that they keep track of all these things with the day and age of databases and all that. So they're going to be able to track this a little bit better going forward of whether or not people are actually using up their $30 million exclusions. There are some estates that can, and when you get into really large farms, we can start hitting some of these numbers. State level is a different thing. So in a lot of states, they have an estate tax or an inheritance tax, and some states don't. I practice in New England, and we predominantly have an estate tax in each of the states. So you might not have a federal tax estate problem, but you can run into a state one pretty easily with farms that Vermont, where I'm located, it's $5 million. I did change some of these slides because it has changed in a lot of them. We have Maine at $7 million, Massachusetts is $2 million. So you might not have a federal estate problem if you have a large farm or withholdings or anything like that. But you could run into a state tax issue. So always something to work with your financial advisors on.
Nick,
income tax.
Nick, if I could just say one quick thing.
Of course.
That value, the estate value, is the net value. So one thing that we might see is a farm with all their assets that's worth say in Vermont, 6 million, but they have 2 million in debt on that farm. So there's at net estate value is only 4 million. So they still fall below that estate tax value. Is that correct?
Unless they stepped a couple $1 million into their stocks. Because it's their net, it's everything added into that pot. So
Right.
while your liabilities do come out of it, you got to make sure that you're looking at the whole pot that you have going on.
Right.
Income tax is pretty straightforward. We earn money, we send some to the IRS. Now, when we're transferring farm assets, the assets would go to the generation buying it. The money goes to the older generation, but we want to make sure that there's enough cash flow that can support the tax bill that might come through and the two families living on this kind of farm. So the parents would have, like, say, the gain on sale. And what can happen, though, is that the younger generation, if they buy the farm, they lose out on that step up in basis that happens. And we'll hit some of the terms right now. So step up in basis. So basis is what we buy something for, less what we depreciate. When somebody passes away, we get what's called a step up in basis to what the fair market value of the asset's worth at the date of death. That's a huge tax benefit that we have out there. The only problem is somebody's got to die to make it happen. So a lot of people like to avoid that in the farm transfer process. So we have the step up in basis, and then there's also carryover basis. So if we give it away, we have what's called the carryover basis, which is what the basis is of the person giving it. So mom, dad buy the farm for $100,000. They give it to son. It's only worth the $100,000 in that land, even though, with the land prices have skyrocketed, it's now fair market value of like $1 million. If they gave it to the son the day before they died, that son would have lost on the step up in basis of about $900,000 because he would have gotten the carryover basis in a gift instead of the step up in basis in an inheritance. When you sell something, I did mention taking depreciation on the assets that you sell. Usually the fly in the ointment in all my transfer of farm assets is this depreciation recapture. So when we buy an asset, we either take an expense or we take an expense over time, which is depreciation. With the accelerated depreciation rules, sometimes we can take all that asset expense in 1 year, even though that asset's going to last more than 1 year. So that's what we call the accelerated depreciation. You might hear it called a special bonus depreciation or Section 179. When we go to sell that asset, so we got the benefit when we bought it and we wrote off ordinary income through business. When we go to sell that asset down the road, we have to recapture that benefit as ordinary income. So I like to, when people ask me how much is their equipment sale going to cost them, that's the most expensive part of any of these farm sales. I sold a tractor for $100,000. Why is it going to cost me $25,000 in income tax for selling that, as opposed to the piece of land that I sold for $100,000? That's going to get better capital gains treatment. So when we sell something, it depends on the nature of what it is we sold, how long we've held it, and what we've done with it through its life, like expensing through depreciation. One of the nice things about income tax is that you keep hearing this capital gains tax, but some people say it's like a bad thing, but actually the capital gains is the preferential tax treatment that you want when you sell something. Ordinary income is ordinary income tax rates. Capital gains is subject to where you're at with your adjusted gross income. But if you're in the 15% tax bracket, any of your capital gains tax is going to be taxed at 0%. So say somebody only makes $20,000, but they sold, $10,000 worth of timber, that qualifies as capital gains. They might pay zero tax on that $10,000 of timber. It all depends on where you end up in the ordinary tax brackets. And you might hear a lot of times that tax brackets are marginal, is that I describe it as buckets. So you have, there's probably like 5-6 tiers of tax, 0 to 15, 15 to 20, 22, 25. Each of those is a bucket, and you fill up each of those buckets until they're full, and you're paying your taxes on the last dollar of whatever bucket that you ended up in. So a lot of people will say, I ended up in the 22% tax bracket. Not all their income got taxed at 22%. It got taxed in a step up to 22%. Hopefully that makes sense. It's kind of a complicated concept. Cash flow, we got to watch out for. If the older generation is going to be a landlord to fund their retirement, can this farm actually pay both the younger generation and the older generation for being on there? So can the farm sustain the younger generation's lifestyle and pay the rent to the older generation? It's one of the things that we want to make sure that even though the sale looks good, we want to make sure that it cash flows so that there's sustainability through these transfers going forward. And I mentioned this before, equal versus equitable. Having like the younger generation come in and invest that sweat equity that we talk about, that they get it paid for and it's represented in the transfer. A lot of times when your work, we're finding with the younger generations, they've worked there for 10 years, but they've got nothing to show for it except, promises maybe from the older generation. So a lot of times what we work for is partnerships. And I'm going to bring this up in a little while of profits interest. And we're able to transfer equity through sweat labor through a profits interest LLC, where we can say, all right, Junior is working his butt off. We're going to put 75% of the profit of this venture to him. He's going to pay tax on it. He's going to grow the appreciation, and his what he owns will grow through his work and through paying tax. I get asked this all the time: what is the best entity for succession planning? The common thing is the LLC, but the LLC can be a couple different things. It can be a sole proprietor, or a partnership with a husband and wife, or a partnership with many, many people. So just because you say you're an LLC, your tax person probably going to ask you a few questions like, hey, did you set up a partnership? Do you have an S corp? Where are the entity docs? Did you talk to a lawyer and set this up? Is there an EIN number? A lot of my people that say they set up an LLC, but it's a sole proprietor LLC, they hand me the documents. It's actually a partnership, because it's very easy to go on irs.gov and get an EIN number and answer some questions that might not be correctly. Husband and wives, while sometimes can have that qualified joint ventures that we've talked about, Mike mentioned it earlier, typically the IRS is going to lean towards, hey, you should be if you're both working on this business, you should be a partnership, not a qualified joint venture. The qualified joint ventures are a little bit more for real estate kind of things, where there's a little bit more passive income. If you're actively participating in a business, you should be paying self-employment tax, that kind of stuff. And that lends itself to a partnership LLC a little bit more. Just want to throw a couple of the other tools that we use in the farm transfer process.
Nick,
Nick,
if I could just interrupt.
Jump in anytime.
Yeah, well, just on the clarification, when, very often we're setting up an LLC to bring in the next generation as partners in the business. And then at that point, because the LLC is what's called a disregarded entity by the IRS, and you have to elect how to have it taxed. And it can't be taxed as sole proprietorship when you're bringing in more than one group, group of people there. So you have a choice between the S corp or the partnership. And what I usually tell people is that I see is most farms end up getting taxed as a partnership, and there are only a few cases where there's good reason to get it taxed as an S corp, and that I have just enough knowledge to be dangerous, and I'm going to send them to Nick Bullock to tell him which one that should be. And maybe you can just make a comment if you want on why someone would choose between a part, or why you would recommend to somebody that they be that with this new group of people, that the next generation coming on, why that you would have them taxed as an S corp or a partnership.
I like both of them. but I like S corps for a specific reason. I like them for highly profitable service-based industries. I like partnerships for highly volatile, asset-heavy industries. Farming is a highly volatile, asset-heavy industry. Now, the reason I like partnerships for farms is the debt can add to your basis, which is really kind of when we're taking in years that there's losses, we can take those losses on our income taxes. Now, if you're in an S corp and there's some real basis rules that happen in an S corp, if you're not having a profitable year, you might just only be able to write down to zero your loss for that year and have to carry it forward due to basis restrictions. Partnerships are a little bit more forgiving for that, and they're a little easier to get in and out of. Now, S corps are fantastic, like I said, for highly profitable service-based industries. I refer them to a lot to doctors, lawyers. You know, there's a lot of great reasons to have an S corp. Farms typically will do partnerships. It's a little easier to turn the profit loss on and off in a partnership because you can just have an annual meeting with, everybody that's involved, all the partners, and be like, okay, this year, let's have the younger generation pay 75% of the profits and loss if your operating agreement allows you to do this. Sometimes they're set in stone. You can only do it what your partnership agreement says, but you're able to kind of move that income and expense a little easier than saying in an S corp. S corps are great because you're able to pay W-2 wages, which is nice, and have some
to owners.
Yeah, to owners. But moving moving percentages in an S corp is a little bit more difficult because it's selling shares in a stock in an entity, and you can only kind of do what those rules are letting. So partnerships kind of are a little bit better for asset heavy, volatile industries because you can take as long as you have basis, you can take those losses, which are really nice. And
well, thanks.
I think the limitations of the S corps.
Yeah, that will answer the question. As I said, when most people when they create the LLC, I tell them to go to their accountant, ask them. 90%, probably 90% of the time, they say, "Wait, you said this should be filing taxes as a partnership."
And if down the road an S corp is a reason, you can always elect to get into the S corp world. But if you jump into the S corp, electing back out as a partnership can be a lot more tricky. So just be careful with what you're doing and reach out to any trusted professionals that you can before you get in. I tell a lot of my clients, we want to make sure that you have when you get into business with somebody, really take the time to set up a partnership agreement or the documents there that kind of explicitly say, hey, what we're doing, how we get back out if this doesn't go the way we want. And really kind of have everybody on the same page on what happens in disaster situations, death of a partner. Get all that done when everybody's agreeing at the beginning instead of, hoping that it solves your problems down the road when nobody's read the partnership agreement since they signed it at the kitchen table. So just be careful.
And we will be talking about those operating agreements in more detail next week with the attorney. So great. I think maybe the last thing I'll just say, if a farm family chooses to put the real estate into an LLC, my understanding is under that circumstance, you absolutely should never file as an S corp for that. Is that correct?
We don't like them for real estate companies being S corps. Now, the reason for that is something that maybe everybody's heard of is that you can get double taxation. So if you put real estate into an S corp and you want to get it out, the only way to get it out is to sell it, and then you want to get the cash out of that S corp. You end up having to pay interest and dividends taxes on the cash coming out, as well as the sale of the real estate. Partnerships are a little bit more forgiving with getting real estate in and out of. So just you want to make sure that you don't move. You choose an entity for the right reasons and do your research before you get into any of these entities.
Great, thanks. I'll let you get back to where you're at.
Okay. So yeah, some of these are the tools that we use: wills, trust, power of attorney, living will, life insurance. Sounds like you're going to cover a lot of these things. when you're doing a farm transfer plan, you want to make sure all the bases are covered. And trusts are a great tool to avoid probate. But if you don't have a will, most people should at least walk very slowly to a lawyer and help get a will set up, just so you're in charge of your destiny and what happens to the things that you've accumulated in your life. There's only about 4 ways of getting or selling or transferring assets in this life. You can give it, sell it, leave it, you can earn it. And the last one I like to throw in here is a combination of those 4. Giving it, we've kind of covered this in the very beginning, it's pretty straightforward. No gift or estate taxes as long as you're under that $30 million threshold right now. Watch out what state you're in. For the younger generation that you're giving it to, there's nothing to do. The only thing that you're going to have is that you get that carryover basis. So if I give you land to the younger generation, and it cost me $100,000, but today it's worth $1 million, you have that loss and step up. So if you're going to have somebody that's going to be turning around and selling that asset down the road, you can really lose out on a huge tax benefit by giving it. But it's a relatively straightforward way of transferring assets. It keeps everything down. And if the younger generation's never going to be off that piece of property, and that step up in basis might not have that value. Typically, it does. Selling it, the gain is dependent on when you sell something. I sold that land for $150,000. I bought it for $100,000. I've got $50,000 of what's capital gains if I've held that asset longer than a year. Farmland's a little bit different. You can get capital gains treatment on most anything you've sold more than a year. If you're in farming, some of the fun, weird ones are cows. They have a holding period of 2 years. You have to hold your cow for 2 years to get that capital gains treatment, because that's when the cow freshens and has a young one. That kind of describes, if you're in dairy, that it gets that capital gains treatment. Otherwise, it's going to be ordinary income. I can get into the minutiae on that one. Like I said, I'm going to try to keep this at 30,000 feet and not bore everybody with the capital gains versus ordinary income, the rules. So if the older generation sells to the younger generation, they get they have to pay tax on the sale minus their basis, and the younger generation gets to their basis in it is whatever they paid for it in the year's sale. So pretty straightforward. We're going to get into some strategies and an example real quick, just to kind of show how each of these assets kind of are a little different. Installment sales, we mentioned that. That's where you have any part of that sale is going to stretch into more than 1 year. So if you sell that land for $150,000, but I'm only getting a check for $75,000 this year and $75,000 next year, I get to report that gain over 2 years. Now, when I help people out, I always make sure to look at this year. Hey, we just report this all in 1 year. Are we saving any money by doing an installment sale? But it is a very, very big tool, because if you can stretch it over long enough, you can maximize those 0% capital gains tax rates. Sale price allocations, everybody's got to agree on what's being sold when. This is really important in big farm sales. I'll have some people come to me and say, hey, I sold the farm for $1 million. Like, okay, well, what did you sell and how much? What was the equipment? What was the land? What was the farmhouse? And these sale price allocations matter on how we break down and what ends up being the tax bill at the end of the day. Personal residence is a prime example of this. Anybody that sells their personal residence, if they meet the test, there's 5 tests that you have to meet on whether or not you've lived there long enough to qualify for the sale of the personal residence. Single is $250,000. Married filing jointly is $500,000 of excludable gain from the sale. So if somebody sells their house for $750,000, but they bought it for $450,000, there's a chance that they might not have, if they're married filing jointly, they might not have any tax to pay on that sale. It's one of the big homeowner provisions in the IRS tax code that helps people out. Unharvested crops are something that we have to watch out for in farm sales. That is self-employment income, really should be included on your Schedule F if you had sold it as if it was part of the business. Depreciation recapture. Anytime that we have that benefit of depreciation expense, when we go to sell those assets, we have to look at the nature of that and whether or not there's depreciation recapture. This plays into installment sales in one tricky way, is that depreciation recapture, the tax on that is all due the year of the sale. You can't spread that over many years. So if you have somebody that sold the farm but didn't take any cash up front, so that the younger generation needs that to get going, they might have a big tax bill due to depreciation recapture that there's no cash to pay. So be careful with that. We talked about development rights. A development right is when you have a piece of land, and there's a lot of organizations that are out there that will pay you, that they're going to write on the deed, say, hey, this will never be able to be developed. And I'll definitely elaborate on depreciation recapture. That the development rights have been sold, so it's actually written into your deed. So it's a one-time sale. It follows the property forever. And if somebody sells that development rights, it is a taxable event. Most people would defer the tax on that by reducing their basis in that property. So mom and dad bought the farm, 100 acres, for $200,000 back whenever. Since land's not depreciable, that land held through. One of the development right buyers, they write you a check for $200,000. Mom and dad take that money and they've reduced their tax basis by $200,000. So now that land in their pocket, they don't have any money into it. They've deferred that tax bill to down the road when they sell the land. So if they, in a couple years after they sold the development rights, nobody wants to buy the farm. When they go to sell that piece of property, it's now worth whatever the cost less the land, the sale of the development rights. If that's whatever that is, that's going to be your new basis in the land. So in that example of $200,000 we bought it for, we got a check for $200,000 for selling development rights. That piece of land is now in our bucket as zero. So if we sell it for $500,000, that whole $500,000 is taxable. So that's what we mean when we've deferred that gain down the road.
And maybe just to clarify, I wanted to just come back. So in that example, though, if part of that $500,000 property is the personal residence, then that portion would still, whatever that allocation of that $500,000 is to the personal residence, would still not be taxable.
And you can't use the personal residence to offset the development right. Typically, they won't give you that money for the personal residence. Usually it's like 2 acres and something like that. So usually there's a little bit of a basis, but.
Well, many of the farms are, depends on which state you are. Like in Vermont, the house is generally conserved. A home at least is conserved with the property, and so will go in that sale. Whereas in New Hampshire, they exclude the houses from the easement. So it really depends on where you're at.
Yeah, definitely.
But I did want to just ask you to clarify one other thing. So let's say that let's not even have the easement part in the mix here, but you've got a $500,000 farm that you're selling, and you want to allocate a portion of that sale towards the residents. Do you need an appraisal to determine what portion you can actually allocate of that $500,000 to the house in order to be able to take that exemption? Or do you use a property tax assessment, or you come up with a number and hope the IRS accepts it?
I push back on my clients and make them come up with it. So sometimes they'll go and have the appraisal done because that's being done anyways, because it needs to be financed. And the person buying it wants to have that. So, they know what they can depreciate, or what's the land, what's all this. And I really try to push that everybody should agree on this, because if the sale is examined by the IRS, they're going to be like, well, you put $500,000 on the primary residence and none on the land, and the person buying it put $100,000 on the personal residence and $400,000 on the land. And at that point, they're going to be like, is there appraisal? They should have had a statement where you both kind of agreed on it. I like to see that is some sort of an agreement between the two parties of what that sale price allocations are going to be. And yeah, you can use property tax bills to kind of get to those numbers. You can use appraisals. Just as long as you're both in agreement is kind of what I'm looking for. I just don't like it. I push back so people don't make me do it. Because that's really where I'd get in trouble, because I have no business doing that. That's an appraisal or in the sale process.
Yeah, I do see that come up in the discussion between the attorneys with the purchase and sales agreements on the properties.
Yeah, people want, the seller wants it on the stuff that's going to give him a tax break, and the person buying it wants it on the allocations on the stuff that's going to give them a tax break. So in a perfect world, everybody loses a little bit, right? All right. So here's an example. Hopefully I'll answer some of the questions about depreciation, recapture, and everything. So we have $1 million farm sale. We've allocated $350,000 for land, $200,000 for the personal residence, $100,000 for the farm buildings, $150,000 for equipment, and $150,000 for dairy cows, and with $50,000 for unharvested crops. So we're going to go down through each one of these and see where they land. Key considerations, there's some good stuff. So there's capital gains. We got the sale of a personal home exclusion. We can do an installment sale to hopefully take advantage of some capital gains treatment. There's some bad, that depreciation recapture. We saw that there was some equipment being sold for $150,000. Well, if I took all that, my tax basis in there is the $150,000. Say I bought the equipment for $250,000, but I've already written off that full $250,000. That $150,000 is going to be all depreciation recapture, taxed at ordinary income tax rates, so much higher than capital gains rates. We also saw the unharvested crops of $50,000. Those are what we call hot assets. These are subject to self-employment. So even though that you're going to have $1 million farm sale, not all of it's going to show up in one spot on the tax return. Some of it's going to get broken apart in different things. And it's up to the tax preparer, whoever's doing it, to kind of demonstrate where everything is and that it was reported correctly. So, the $50,000 worth of crops would have ended up on your Schedule F as subject to self-employment. The equipment sale of $150,000, that's going to be subject to depreciation recapture. That's ordinary income. The sale of the land, if it's been held the amount of time, is going to be capital gains treatment. That's going to be your best thing. The sale of the personal residence, since they had it there for $200,000, more than likely that $200,000 is going to be completely exempt from tax. You still got to show on the tax return, but it reduces the amount that you're going to pay in tax. Digging a little deeper, the capital gains advantages for taxable brackets on the sale of assets, that sale of the personal home. And then, the installment sale is a huge, powerful tool that if you don't look at it in these farm transfers, you're definitely doing a disservice to your clients. So now that depreciation recapture, this is the fly in the ointment. Sometimes I tell my clients in this farm transfer to a younger generation, sometimes you're better off giving the equipment away. And that really doesn't hold very well with a lot of people, because they worked really hard. They wheel and deal, they get this equipment. But the amount of pain that comes with the tax from selling equipment, a lot of times when it's $100,000 worth of depreciation recapture, it can be a $25,000 tax bill. And that's very substantial. So it can be, 75 cents on the dollar. Whereas if you're selling land, you're paying 10%. Very, very important to take a look at it. And it can cause a real issue with installment sales, like I said. So in our example, $150,000 of that has to be reported in the year of sale. So there's probably, a good $30,000 to $35,000 tax bill in that year of sale right there. And if you did, owner financing and I don't need any money right now, and all of a sudden you have a $35,000 tax bill, it can create some serious tensions. So, a good plan is always you're looking forward and making sure that you're covering all the bases. And then the hot assets, it's pretty much unharvested crops, feed in the bunk, things like that, that your banker is going to really notice that, hey, can you put a fair market value on these things, even though the things that you grew, they're definitely something you sell, but you would have sold them in your normal, ordinary course of business as it was.
Nick, there was a specific question here. This
Mm-hmm.
depreciation recapture extends even to 6-year-old equipment, and the depreciation was taken for it in the first 3 years.
Yep.
Okay.
All the way. Any equipment, anytime you took depreciation for something, whenever you go to sell it, then it's subject to the depreciation recapture. Properties are a little different. Land isn't depreciable, so that's always going to have, there's no depreciation recapture for land, but buildings can, and that's when you're getting into the kind of the weeds of the tax code. If they've been held the right amount of time and they weren't accelerated on the depreciation, it's going to be much less than the equipment. But if it's a dairy barn that you took the full amount in the first 10 years, you're probably going to get hit with depreciation recapture even on buildings. Rental properties, you don't see it too often if they're being held the amount of time. And like I said, we're getting into the weeds because you have to recapture the difference between accelerated depreciation versus straight line. And you want to reach out to your tax professional when it comes to that. Hopefully that answers those questions. Happy to have a chat about depreciation anytime.
I think, there was a comment about how this is complicated and it can deter people from planning. I think that what we're trying to do here is quite the opposite, is to say, look, just go in wide, eyes wide open, right? Because if you get to a point where you're just having the sale and you're finding out later, because you didn't do any planning, that you're getting hit with this tax bill, that's where the problem come in if you don't have the cash, because you've put that cash allocated somewhere else. There's, Nick has said a couple of times that the problem where this really creeps up is in the installment sales, where you're trying to help that next generation by doing seller financing. And you may not even ask them to, as Nick gave in his example, you may not even ask them for payments that first year to help them get their feet underneath them. And then you're going to have to pay that depreciation recapture that year, even though you didn't get any income yet from the sale. And so sometimes it's about how you structure it, or just how you budget money, or are you working with an accountant where you can figure out ways where it's going to be minimized, or your other tax liabilities are going to be minimized in that year. We just have seen this, this one in particular becomes one that people really aren't expecting, and you really need to talk to a tax professional.
All right, so back to our example. We had that $1 million farm sale. The land that we sold, that gets that capital gains treatment. That's part of the good. The principal residence that got the exclusion. That's the very, very good. The farm buildings could be subject to depreciation recapture. The equipment is definitely subject to depreciation recapture. I mentioned the dairy cows. Now, when we sell dairy cows, they can qualify for that capital gains treatment. They're a business asset. You're not in the business of raising dairy cows. You're in the business of producing milk using dairy cows. So you're selling a business asset that more than likely you grew, because a lot of times, you have the cows that are raised right there on the farm. So they can qualify for capital gains treatment, which is very beneficial and can really help out that younger generation. And they have the unharvested crops, the 50,000, that should be on your Schedule F. Moving on from the sale of, transferring assets, we could also, we could leave it. Junior, you work on the farm until the end, and then when I pass away, you're going to inherit it all. As long as you're not hitting that $30 million or one of the state tax exclusion amounts, no estate taxes due. Anything that you leave, it would get that step up to fair market value. The inherited property. So if we leave that $1 million farm, the buildings, the cows, all that stuff that gets that fair market value step up. And then the younger generation can redepreciate some of those things, which is a huge benefit. Or if they go to sell it, they're going to pay a lot less in tax because they got that step up to current fair market value. And it's relatively straightforward. Do I need to go back to depreciation recapture? We seem to be.
Maybe you want to just address Anita's question real quick.
I didn't catch the question. I just see it.
Well, so I think she's just asking about even if the equipment is 30 years old and you still may need to pay the depreciation recapture on it. And I think the answer is yes. If you're selling it, it's plus value. Right.
You got the benefit. So we have a tractor we bought in the 70s, $100,000. We used it in business. We depreciated it either up front or, over time. And so we bought that $100,000 tractor, and through depreciation, it's now our adjusted tax basis is zero. So even though we bought it for $100,000, we took an expense that reduced that down to zero. When we go to sell it for, say, $50,000, we have to recuperate that benefit that we got. You don't get capital gains tax treatment. It's just subject to ordinary income tax rates. So it's a higher income tax rate of that $50,000. Now, for instance, if we have that 70s tractor, and a lot of my farmers can do this, they buy something, they run it forever, and then they sell it for a profit, like massive. So we have a $100,000 tractor. We took $100,000 worth of depreciation. They sell it for $150,000. Well, they have $100,000 worth of depreciation recapture, ordinary income, and then they would have $50,000 of capital gains. I hope that helps. It's not really based on how old something is. If you got the benefit of it, they're going to look back and be like, okay, well, then you need to have that benefit be paid back either through ordinary income versus the capital gains tax rates.
And the thing is, if they're selling a 30-year-old piece of equipment, so it obviously has some value. So you're going to, right? So if you're giving it, so it's 30 years old, I'm just going to give it to you, then there's no tax, right?
No tax. No. Yeah. I mean, yeah, if you depreciated it down to zero and you gave it away, whoever gets it from you, they would get it at that carryover basis that I talked about. So it'd be zero to them. And if they sold it, then they'd pay tax on whatever that difference is.
Yeah.
All right, let's keep going on. So if you leave it very straightforward, people get a step up in basis to the fair market value at the date of death. Depending on what the asset is, you can get certain tax deductions, or if you go to sell it, you might not have to pay any tax. So the classic example is mom left me her house. I don't get a principal home exclusion because it wasn't my house. I didn't live there, but I get that step up in basis to the fair market value. So the house, at her date of death was worth $200,000. I sell it for $205,000. I have a $5,000 gain because I have that step up in basis to $200,000. Well, the last one, we just kind of earn it. We form an LLC. We transfer some assets. Say dad holds on to the real estate personally. He transfers all the cows into an LLC with the younger generation. The younger generation didn't have anything to come into it, but they started a partnership, and then over time, through the earnings of that partnership, dad turns on the valve. So the son's paying 75% of the profits on that, and we can transfer assets using an LLC by having the younger generation pay tax on the profits and earning the untaxed appreciation. So when that $150,000 worth of cows that got transferred into this partnership in 5 years turns into a $500,000 tax cow herd, the younger generation could own up to, like, say, 50% of it if they've been doing this profits interest LLC, transferring ownership, instead of just coming in and holding on when they went into day one at zero. So, Profits interest LLCs are a powerful tool that we have that helps us transfer ownership in entities, and you end up paying tax on the profits, but the growth in the business can transfer over to the other partners, and it can be a very powerful tool.
So I'll just mention that since most farms are volatile, it's like you said, not consistently profitable. In most cases, I see that the profits interest LLC doesn't work for most farms because there isn't a consistent profit to transfer to do work on the transfer of assets. So instead, what we're primarily setting up is capital interest
Yep.
LLCs and not profit interest LLCs. I don't know if you want to comment on that.
I do have a slide on that and down the road, but yeah, the trick in the profits interest, it's great as long as there's profit. Now, if you have a capital interest, when that just is the capital interest is your value as if we sold everything today, what would I get out of there? That's, so if the younger generation put in 0 and there wasn't any provisions in there for them to receive any of that capital interest, the person who put that $150,000 of cows, they'd have most of the capital still. So they'd want the check coming to them, not to the young, who didn't put anything in. Now, if you're going to transfer capital interest, they can either sell it or buy it. Well, sell it or you can give it away. Now, you can give away up to $19,000 a year. So you can move that capital interest, but you have to use either a sales structure or a gifting structure to make that happen. The nice thing about what's called a profits interest LLC is that you can move that interest without actually having to do the gifting or the selling. So they kind of earn it. Hopefully that's clear. It can be quite complicated. It can be a combination of both. Sorry.
Just wanted to just clarify again with the 19,000, and this was just coming up with a dairy farm that I was working with 2 children, who they're going to gift several $100,000 worth of interest. The cattle and equipment have been put into an LLC. The real estate's going to transfer through the estate, and I think you're going to talk about this combination here. But the LLC with the cattle and equipment has several $100,000 worth of assets in that, and their intention of the parents is to gift those shares over the next their shares in the LLC over the next 5 years. And so it's going to be impossible if even with each parent being able to gift 19,000 to each child, that still is not going to allow us to do it in 5 years. And so the idea is that they will transfer more of that of their equity, more of the assets, more of the shares, I should say, in the LLC than the 38,000 times 2 that they could give to those 2 children over the next 5 years. And so they are going to give more than that amount each year. And so the only implications for that, and correct me if I'm wrong, is that they're just going to have to file a gift tax return to record that they gifted more than that annual exemption, but there's still no tax due.
No tax due. They'll fly in that ointment. There's always one. Is that if you give partnership interests, using that 19%, we kind of use
19% or $19,000.
That $19,000 is that you're getting underneath that reporting requirement. Now, if you give more than $19,000, unless it's cash, the IRS is going to require that you probably attach a appraisal to let you know how much that partnership interest is worth. And you probably don't want to have an appraisal done of a business every year to just transfer some of that partnership interest. Just watch out for that. That's why people like to use that $19,000. They kind of figure out how much is 1%, how much is $19,000 in the percentage of the business. And that's why that moves a little slowly that way. Or if they're going to move a lot, all right, we're going to move 49% of the business, we're going to do a gift tax return. So we have to have that appraisal. And the IRS requires that if you're gifting more than $19,000 that doesn't have like a cash value, something that you can really kind of a tangible thing to really put your hands on, that you're going to need to have an evaluation done so they know how much that gift is. So just, I work with some big farms that can be an impediment that keeps them at that. We're only going to move 1% a year because that's what $19,000 equals. So just be careful.
So that appraisal, it has to be done every year. It can't be done like for 5 year, have a 5 year. Like I think I've heard that you can do that with real estate, right? I mean, it's like,
appraisals are typically only good for just over a year
okay.
for the IRS. At least that's what we've been finding. But I've never had anybody question, like I said, you do the gift tax return. I've actually never had anybody question the gift tax return.
You mean, are you filing the appraisal with the gift tax
No,
return?
no, you have to have a certified appraisal. That has to be attached to the gift tax return, and you send it off. But I've never, in 25 years, I've not had anybody question that as long as I've done that correctly.
So you're saying it might be, if it's the same appraisal, it may slip through.
I, I, that is one of the impediments of using
Yeah.
the gifting is that appraisal. When I mention that to people, they're like, that's expensive. So just be careful when you're doing that.
And maybe you can cover this in this slide. What would be the difference if, say, they're earning shares as a part of compensation, in lieu of wages or reduced wages?
No,
No, what? Well, what's the tax implications there?
the tax implication is if you're doing that in an S corp, you can actually put a value on shares, but a partnership percentage, you're not getting a paid a wage anyways, because in a partnership you can only take draws or guaranteed payments as an owner. And having that be part of adding to you can have, if you say, okay, I'm going to take $50,000 out and put it back in the business or pay dad with that. That just you'd want a purchase and sale agreement that you're actually buying and selling the partnership interests instead of, it doesn't really work as far as that's the profits interest you're really trying to do a hybrid of. All right, I've got some slides coming up, but usually it's a combination of everything. So you have you give you take the core farm and you put it in a real estate LLC, and you give 25% of that to the younger generation. You hold the remainder of the rent so you can collect some rent in retirement for cash flow. You sell some dairy cows on an installment agreement that the son then puts into the LLC, so they have some capital coming into it, and then you have the younger generation pay most of the tax on that. So when the farm can kind of transfer through the normal taxation route and the appreciation of that LLC. So you don't want to just come at it like one size fits all. Sometimes that does work for people, but usually having some sort of a mix is going to be the best result for the taxpayer. Next 10 slides, I basically just kind of cover the same things that we talked about over again. I just want to make sure that, we cover it real kind of quickly. You say it once, you say it twice, right? So, the A wants to transfer 50% of his business. He can sell it, he can gift it, or the younger generation can earn it. If they sell it, there could be a large taxable gain. The person buying it might not be able to cash flow it, might not be able to qualify for the financing because all the actual assets are still being held, like the land, by the older generation. You got to watch out for that depreciation, issues. So selling it sometimes has some real pitfalls. Gifting it, the older generation worked hard for their equity. Why just give it away? You might end up using up your lifetime exclusion. Used to be more of an issue, but with current estate exclusion amounts, that's less of a thing. But that $19,000, if you're trying to move, $19,000 of $2 million LLC, that needle's going to move real slow. The younger generation might not be ready, and who knows, if there's many siblings, it might not be equitable. You just want to make sure that you look at the whole picture when you're doing these things. And that's where we get into this Profits LLC. If it is a profitable business, the Profits LLC can really work well to transfer ownership in assets to a different generation, any partners that are getting in there. So it can be a real good exit strategy for the older generation or the younger generation, somebody that's trying to transfer that farm, that stewardship of that land, and have some control of it. Like I said, the timing can be really controlled because you can just have, in a partnership, you can have an annual meeting and say, hey, we've done 50-50 profits lost the last couple of years, and your equity is growing, but maybe we want to have that move a little quicker. Let's say, hey, you're going to move 75% of the profits to the younger generation, and it'll move that equity much quicker. We talked about a capital interest with Micah before, so there's a capital interest and a profits interest in any partnership. So the profits is the profit and loss from the business, and the capital is that equity at the bottom. So the capital interest entitles the recipient to a share of, like if we sold everything today, who gets what? That's what we're talking about, a capital's interest. The profits interest is a share of the earnings and losses from that current year and any kind of future appreciation. The assets in the land are going to be worth more in a year than they are today. So when we move 50% of that, that untaxed appreciation can really have a lot of movement to bring in a younger generation. And so a lot of times how I describe this is, so we have, $100,000 worth of profits, 75% goes to the younger generation. The assets are worth $100,000 this year, but they're worth, $300,000 next year. So they had $200,000 worth of growth that year. That $200,000 at $150,000. So that younger generation's equity grew quite considerably in that 1 year. That's what I'm talking about when that untaxed appreciation is the growth in the assets of the business, not just the income and expenses that we pay taxes on. When you transfer capital, it's either a gift or it's a taxable. You're either selling or giving something. But if you're having somebody earn it, there could be tax-free to both parties if it's set up correctly. This is what I'm talking about, that ownership interest. This is, 50%, over 5 years, 10 years, they go from owning nothing to owning 36% of the business over 10 years. If we accelerated that tap and we moved it to 75%, they go from owning 0 to 54 in this example. So we can control the timing and how that moves a little bit more with just a simple meeting of the partners in the partnership. This can backfire. So you can get equity in certain different ways. You can add money to the entity. You can have a profit that you pay tax on, the appreciation that I mentioned. Your equity can go down. You can take money out of the entity. You can have a loss that's going to reduce, the total value of what you own, or the depreciation. If you use accelerated depreciation all the time, that asset, whether you bought it for, you already wrote it off, so it's not adding to your bottom line. We got to watch out the depreciation during the down cycle. So if we're taking, accelerated depreciation to generate a loss, if we have a profits interest, you have to have a profit. If you have a loss, that plan is going to backfire, and their equity is actually going to go down. I talked very briefly about a guaranteed payment in partnerships. So if you're a sole proprietor, you have your income, you have your expenses. What's left over is your income. That's what you have. Either you pay loans out of it, or you actually are able to put money in your bank. When you're in a partnership, there's the income and the expenses, the loans. You can take money out either by taking a draw or a guarantee payment. Now, a guarantee payment is saying, I'm going to pay this amount of money to you from the partnership every month, regardless of the amount of income or expenses that's there. You end up paying, self-employment on that, on your personal, and it adds to your basis. It's kind of tricky partnership stuff. But a draw, you can pull money out of a partnership as long as you have basis in that partnership. So if I put $100,000 into a partnership and I never took any money out, and we had a profit of $50,000 and I had 50% of that, at the end of the year, my basis is $125,000. I could pull out $75,000 if there's cash and not pay any tax on that, because I have enough basis to pull a draw. We use guaranteed payments a lot because typically when a younger generation comes in, they didn't put in $100,000, but they need, $50,000 to live on. So instead of having that capital account go to negative $50,000 that year, we allocate $50,000 worth of the profits to that person, and it soaks up that guaranteed payment. Very powerful tool, and useful in transferring partnership interests. We got to watch out for built-in gains when we transfer assets. So if I have that 30-year-old tractor that we all say is worth $100,000, but I already took the expense on it, and my tax basis is zero. If I put that into the partnership, that has what's called built-in gains. There's a tax problem right there. So if that partnership sold that tractor in a year, it would have ordinary income, even though it never got that benefit. I used that benefit, and I got that benefit when I passed it into the partnership. So just be careful with that. This is a demonstration of if we have the losses, that profits interest can backfire, and it can actually not accomplish our transfer of ownership that we were hoping to. So make sure a good plan, it has to be well thought through. So a capital interest in an organization that might not be the most profitable might be a better route to go, and just have that gifting or a sales structure where the ownership of the partnership is moved through a capital instead of a profits interest. I mentioned the guaranteed payments. So typically it's the younger generations that need that capital to live on, that haven't put the money in or earned it through the partnership over years. So typically what we do is we have the older generation taking the draws because they have that capital account. They can take money out tax-free. And the younger generation has that guaranteed payment that has that built in, kind of they're paying tax on. So, I'm almost running out of time here. I want to make sure we can get to some questions. Just make sure to touch on that we have that historically high gift tax and estate tax exemptions. We got to make sure that we're not giving up that huge tax benefit by giving stuff away when we could get a step up in basis. Installment sales, we want to take advantage of that, the capital gains tax rates, and then forming an LLC, making sure we choose the right way that fits what we're trying to do. I covered a lot of stuff today. I'm sure there's a few questions.
Yeah, let's see if there's any new questions out there, including people want to open their microphones if they want to ask a question. They'll maybe try to turn on your camera and raise your hand, or at least raise your hand.
Before we step away, before anyone sneaks away, I'm going to post a survey in the chat. And for those who want to ask questions, feel free to do so, like Mike instructed, but please do the survey before you pop off.
Yeah, that's our evaluation. That's really helpful for us to improve our programming and also to show our funders. I just wanted to wait to see if there's any questions. I'm not seeing any right now.
Great.
Except there is a question, Nick. What state do you work in? So now if you were Yankee Farm Credit, and Yankee Farm Credit merged with Farm Credit East, do you work throughout the entire region or just New England?
The entire region. I do everything from New York to Maine to Rhode Island to wherever we are.
So just on the stepped up basis, this came up last week. I wanted to resurface it again. One of the things that we see a lot is that people want to leave the real estate to the next generations. And part of that, it's not always the only reason, but part of it is sometimes for that stepped up basis. And in some cases, the younger generation would rather have ownership of the farm now so that they can make capital investments in the farm, and also borrow against the farm potentially. And I gave an example of a dairy farm I worked with where he told me he didn't pour an ounce of concrete on the farm in the 10 years he'd been leasing it from his parents, um, even though he needed to make investments in a new manure pit and a heifer barn and a bunker silo. And so his interest was to have access so he could make that kind of investment. And he was willing to forego that stepped up basis because he saw it was a greater benefit now. I just wondered if you
Yeah,
want to comment.
it's a great benefit. Like, a lot of my farmers, they're never going to plan to sell it anyway. So that, why do we need that? And we need that access and to be on it. Transferring it using an LLC could be good. A lot of what we're finding though is, people want the control. And, sometimes the older generation's not able to give up that control. And by holding on to the real estate, they can kind of keep that leash a little bit. So any good deal, if it means enough to the younger generation or whoever's coming in, they might, if they need it, and they might need to come into a purchase and sale agreement and build that into the profitability of what they're doing. You can see it a lot of different ways, but the step up in basis, we just, especially with equipment, I don't like to see that happen because that's one of the best forgivenesses of all is, you just lease the equipment from the older generation, and they pay self-employment income on that. But when they pass away, you inherit the equipment, and all that depreciation recapture is gone. That doesn't fall anywhere. So that's the nice thing about depreciate. That step up in basis is, some of those penalties, that depreciation recapture can go away that way.
Mm-hmm. The other point I make to people is that if you're gifting somebody a $500,000 farm and they decide to sell it later, even if they pay the capital gains tax based on that lower basis, they're still better off because you gifted them a $500,000 farm or whatever it appreciated to at that point, right? So they're not, they're going to pay, they're not going to get the fullest amount, but they're still going to be better off than if they ever had to buy a farm.
Yep.
And then for some people, that's a deterrent. Well, I don't really want them to sell it. So if this tax thing is going to have any effect on them, I'd rather that be the case and not have them sell it. But then, there's also the options for, if they leave it in the next generation will still get the stepped up basis. Or if I've seen some farmers sell their farms because they're needing to buy a bigger farm. And so they're doing, I think in that case, they're doing like a 1031 like property exchange, which you didn't, talk about. But I do see there's.
Thought I had enough complicated stuff to go over than get into the 1031
right.
exchanges.
So there was a question here. Maybe this is more of a question next week for the attorney, but how to integrate LLC for farm and family trust. I don't want all the kids be part of the farm, but do want to leave them personal dollars. I think that's going to be more of a question, Joni, for next week when we have the attorney coming in and talking about estate planning and also structuring the LLCs. Is there any questions in the chat we didn't get to? I tried to actually cover some so we actually did get a number of more legal questions than tax questions in the chat. Is there any other questions out there? Any ones that we didn't cover in the chat? Any that are coming to mind for people?
There was one much earlier, and maybe you feel you've captured it later, which when we were talking about the 19,000 that could be gifted, someone asked if that's similar. Could you also gift it to an LLC up to that cap, or is that something totally different?
Well, I think that's what we were talking about earlier, right, Nick? Is if you're gifting 19, if you have a share, if I'm understanding that question correctly, if you have an LLC that has the and you want to gift a certain amount of shares every year, the 19,000 still applies. And if we get above that 19,000, that's where you need to have an appraisal to show the difference in the value.
That's right.
So whoever asked that question, if that didn't answer it, please speak up. And then did we just get a new question?
maybe that was my question, but thanks for this. This is actually very useful. Um, like if a family has a family LLC, like to just put the profits from the farm or the business into there rather than holding it inside a farm, um, can one of the can like like someone gift to the family LLC, and would that be part of their lifetime gift exclusion rather than just gifting it to the children? Does that make sense? Sorry, I don't know how I'm saying.
I'm not sure if I'm understanding the question. Do you?
Okay. Okay. So, we were talking about lifetime gift exemption. I think it's like 3 million. Oh, 3 million?
You're 30 million
30.
30
for
million.
the
Okay.
federal. The state, it'll apply whatever state you're in.
Okay. So so you can gift that to anybody or an entity, an LLC.
Well, it's anybody. You really can't give an well, I guess you
Yeah.
can. Typically, if
Well,
you're gonna put money into like an LLC, you want something
I,
for it.
I
Either
think
you're
they,
putting in a capital contribution to the LLC, so your basis inside that LLC increases, or
No,
you're
no.
loaning the money.
you know what I'm thinking might address this question. I think the idea would be back to what we were talking about a little while ago is if you're creating the LLC, one of the things that and we'll talk more about this next week that you really have to clarify is what exactly are you putting into this LLC? So usually we're putting in whatever livestock and equipment, the means of operations, and we're creating a list, an inventory of what is actually going into the LLC and what sometimes I've had people retain their own, like, I want to keep this tractor personally or
Oh,
keep certain
okay.
animals
Actually,
personally,
no. For
but
sure.
you
That's
you
not what I meant.
but if you create, but once you create that LLC and you put stuff in it, if you are the primary owner of those assets, you can gift the shares to someone else using those exclusions, but you're not gifting to the LLC. You've already put it into the LLC. That's not a really, I don't know if it's considered a gifting process. You create the LLC and you move those assets in the LLC, and then you can give shares of the LLC to someone else, and that's how they get that, and those exemptions all apply. I don't know if that finally maybe
Okay,
gets the
okay.
question.
Let's say like two kids or adult kids have an LLC set up, and the mother wants to gift her money to the LLC versus directly to the children. Is that allowed? No. Okay, that's fine.
Yeah, and that, yeah, I'm
You're
not
going to
sure
give
what
it to a
that actually
person.
accomplish. Yeah.
Hmm.
It would go to each of the kids, and then the kids would have they're the only ones that can put stuff into it. Otherwise, it's going to be a loan from mom or um, income, or the only people that can really put things into LLC are the people that own the LLC.
Oh, I see. Okay, that's got it. Thank you.
Yeah. So if mom wanted to give like $10,000, it would be like, hey, all right, well, we just put $10,000 into the checking account. Well, that came from mom, but it's really either mom wants to get paid back, so it's a loan, or it was a capital contribution by each of the members.
Do all three members have to give the same amount?
Well, that's really up to mom because she's really giving the money to the kids. So she'd be like, hey, Joe, you got 10,000. I'm not giving it to Ralph. Joe puts that $10,000 into the LLC. He gets a $10,000 capital contribution.
Okay, let's say like the mother is also part of this LLC.
Well, then it would go into, she would have a capital contribution of $10,000.
I see.
I'm not sure. It seems like this is a little more complicated than
Okay, that's okay. That's fine. Thank you.
I think. I think we're maybe getting off the
Yeah, I
tangent.
can do days on partnership instructions. So.
Is there any last, we got 1 minute, any last question, burning question? Otherwise, thank you everybody for being here, and please fill out the evaluation before you leave. Join us next week where we'll have an attorney here to speak through all of the estate legal structure issues next week.
Thank you for letting me speak. Wonderful to chat with everybody.
Thank you, Nick.